Welcome to the last chapter in our course, and this is day one of the statement of cash flows, and what we're looking at here is the fourth required financial statement, required of all companies. This presentation has basically two pieces to it. First, we'll learn to classify cash flow activities, and then the next one is to prepare a cash flow statement. Alright, so we're going to classify it and then prepare a cash flow statement. And what we're doing is we're identifying whether, like a transaction or a change, is an operating activity, investing, or financing. Okay, those three pieces. So the first thing that we're going to look at is this classification. And they start out with an example of a cash flow statement here from eGames. And don't worry about the details in here, okay? Don't look at this. But look at the major sections that we have here. The first one is cash flow from operating activities. And that starts out with net income, and then we make a bunch of adjustments, okay? Then we've got cash flows from investing activities. We got the purchase of investments, sale of land. These involve long-term assets. And cash flow from financing activities, common stock, dividends. These involve changes in long-term debt and shareholders' equity. Okay, so that's what's down here. This is how we finance the business. So if this is investing and that's financing, this is long-term assets, and this is long-term liabilities and stockholders' equity. These changes are all involve current assets and current liabilities, generally. Okay, like 99% of the time. Okay, so here's a description of these activities. That operating activities are cash receipts and cash payments, for transactions related to revenue and expense. They categorize it as revenue and expense, but this makes me a little bit nervous because that can include like a long-term debt or like interest on a long-term debt, or all kinds of things like that, so be careful. And then, so when you think of operating activities, think current assets and current liabilities. It's like a cleaner way to think about it. And then investing activities, these involve the purchase and sale of long-term assets and some current investments, So this would be money that we've invested in for the long term, all right, but it might be listed as current. And then financing activities, inflows and outflows resulted from external financing of a business, So we've either borrowed money from a lender or we've issued stock to a stockholder. So operating, investing, and financing activities. Here's an example of this is a really handy slide, and this is a illustration in your book, illustration 11-2, and this is handy for figuring out what the verb is, what the description of the transaction is. So cash inflows are the sale of goods or the sale of services and collection of interest and dividends. That would be a cash inflow. Outflows, purchase of inventory, payment for an expense, payment of interest, payment of taxes. So these are cash collections because of goods or services or interest and dividends, and this is what we bought, and these are all considered operating activities. Think about on the income statement, think of everything above operating income. All right, except the taxes are in here too. Payment of taxes is different from income tax expense. That doesn't help, does it? And this is cash flow from investing activities. For investing, it's sale of investments. This would be a cash inflow versus purchase of investments. That's a cash outflow. Sale of property and equipment versus purchase of property and equipment. Sale of intangible assets, that's an inflow. But if we purchased an intangible asset, that's an outflow. Collection of notes receivable. I wouldn't say lending, I would say issuance of note receivable. And then the last one is sale of a subsidiary, and this is acquiring a subsidiary. So these are all long-term assets that they involve. So now when we go over to the other side, to long-term liabilities and shareholders' equity, these are financing activities, and we got cash inflows from the issuance of bonds or notes, issuance of stock, and cash outflows repaying a bond or a note. Payments to repurchase stock, so treasury stock purchases are in here, and then payment of dividends. Okay, so what's a little bit tricky here, there are just a couple exceptions to our general rules, but you can see if you pay dividends, that's a financing activity and it's a cash outflow. If we receive dividends, that's an operating cash inflow. Not so fair, huh? But you know, I don't know, there's like two different ways of treating the same thing here, so that can be confusing. But just remember that the collection of interest and dividends is an inflow, and the outflow would be the payment of the dividends. Okay? I'm trying to think. So these are all capital expenditures. I think that's all I've got there. Yeah. So a common mistake, sometimes misclassifying dividends. Dividends received are in operating activities. Dividends paid are in financing activities. Okay, so just remember that one. Now this is illustration 11-4 in your textbook, and it shows it's the same thing again, changing cash, other current assets, and changes in liabilities. Those are all oh no. Cash itself is going to be different, but other current assets and current liabilities, those are going to be operating activities. Okay? All right? And then changes in long-term assets, those are investing. Long-term liabilities and equity, those are financing. Now what this all comes down to is the change in cash. Let's go back to that statement. Okay, so let's say that we get this straight and we're able to do this right, and then you come down to the end of the statement and you'll forget what to do. Okay, so what this is we've got, like, this comes down to a net cash flow from operating activities. We've got a $50,000 outflow, or no, inflow, sorry, $29,000 outflow and a $7,000 outflow for a net increase in cash of $14,000. I add that to my beginning balance, my cash at the beginning of the period, and that has to tie out. That gives me cash at the end of the period. Okay, so this comes down to the change in cash. That's what it is. So we take the net $7,000, the net $14,000, add it to the beginning balance in cash, and we should get the ending balance in cash. Okay, then there's one other thing here. We've got one other note. This is a non-cash activity. This is purchasing equipment by issuing a notes payable, $20,000. Okay, so just think about the journal entry. If you do this, we'd have a debit to equipment and a credit to notes payable. There's no cash involved, but it is a significant acquisition for the company. Okay? All right, I got to figure out where we were. And here this is what they have for non-cash activities. So these are significant investing and financing activities that do not affect cash. Okay, they're reported after the cash flow statement, or they could be in a note to the financial statements. And there's the purchase of a long-term asset by issuing debt. Okay, just because it's not affecting cash, it's not in the body of the statement. We got a little question here. Which of the following cash transactions would affect the amount of investing cash flows? Investing, okay, so it's investing cash flows reported in the income statement. Dividends would be an operating activity, right? Purchase of inventory. Inventory would be a current asset. That would be an operating activity. Issuance of common stock would be a financing activity. So sale of equipment, it's a long-term asset. That's your investing activity. Okay? All right, so we'll do a few problems and then come back and look at preparation of the statement of cash flows.